Let's get back to Canada's economic growth. It was stronger than expected in the first quarter of the year, with an expansion of 2.2% annualized. That's a little higher than economists had expected. It also tops the Bank of Canada forecast. But it was driven, apparently, by exports of vehicles and other goods, partially to get ahead of US tariffs. Let's get more from Michael Davenport, senior economist at Oxford Economics. Michael, thanks very much indeed for joining us. What jumped out for you with these GDP numbers?
Yeah, so really it's what you said, that GDP growth was boosted by exports and inventory building as firms tried to get ahead of potential U.S. tariffs that came into place in the first quarter, but also Canadian counter tariffs as well. Really, if you look outside of exports and inventories, if you look at outside of net export growth and inventory growth contribution, GDP growth would have essentially been flat. Final domestic demand, we look at things like consumption, housing investments, non-residential business investment, government spending. If we just count those parts of the economy, GDP growth would have been flat in the first quarter.
Right. Final domestic demand was flat, and then business and residential investment both fell, with the latter, business or residential, down on a year-over-year basis as well. So, I mean, it's just one quarter, and tariffs are distorting all kinds of economic indicators. I guess that's part of the problem here.
Yes, absolutely. Absolutely. That is a big problem. We're spending a lot of time trying to gauge, when you dig beneath the surface and look at the actual underlying trend in the economy, what's going on. And what we're seeing is that we think the economy has slipped into a recession in the second quarter. We think a lot of the boost that came from exports and inventories in the first quarter will not be sustained. And what we're likely to see is declines in GDP growth starting in the second quarter and moving through the rest of this year.
So you say we think Canada has slipped into a trade war-induced recession. In other words, you reckon we are going to get 2 quarters of contraction in the economy?
Yes, exactly. We actually think we'll get 3 quarters of contraction in GDP from the second quarter to the fourth quarter of 2025.
Oh, so 3 quarters of contraction. Yeah. What about that perennial question? Will the Bank of Canada cut again?
It's a great question, and I think there's a lot of debate out there amongst economists and in the markets as to what exactly the Bank of Canada will do. It's our view that the Bank of Canada is in a bind. We think they are really struggling to weigh the upside risks to inflation from the trade war and tariffs against the downside risks to growth from the trade war. And ultimately, what we think the Bank of Canada is going to do is they're going to continue to hold the overnight rate steady. We're calling for them to continue to pause next week on June 4th. And now, there could be a couple more cuts this year. That's not in our baseline forecast. But what's important is we do not think the Bank of Canada will lower rates substantially below their estimate of neutral, which is 2.25 to 3.25%. So we don't think the Bank of Canada will drop rates. Even if they do deliver a couple more small cuts in the next several months, we don't think rates will fall below that 2.25% lower bound.
Why wouldn't they do that? I mean, traditionally, obviously, they'd be worried about an overheating economy if you bring borrowing costs down too much, but that doesn't seem to be a risk right now.
Well, what we think is at play is that the Bank of Canada is being very cautious about the upside risks to inflation coming out of the pandemic period. So we saw the Bank of Canada really lose control of inflation in the sort of 2022, 2023 period when they were forced to raise rates aggressively. We think they want to avoid any repeat of that type of scenario. And given that they worked so hard to get inflation back down to their 2% target over the past couple of years, we just think that they are going to err on the side of caution here. Also, I would add, what we're looking at here is the shocks to both supply and demand in the economy. The central bank, the Bank of Canada, has been quite clear that their monetary policy tool, their key monetary policy tool of interest rates, is not useful to address shocks to demand and supply at the same time. And it's not useful in a sort of stagflationary environment where you see prices rising, but also demand potentially contracting, which we think we're moving into.
That's interesting. Yeah, they've got this tool and it's not that effective right now. Looking at the Canadian dollar, is it going lower in the next few months, do you think?
Well, we think that the Canadian dollar has strengthened and probably strengthened a little bit more than what will be sustained over the last little while. A lot of that's been driven by markets getting on board with our view that the Bank of Canada will continue to pause rate cuts and hold the overnight rate steady, but also it's been driven by pretty broad-based U.S. dollar weakness. We do think there's going to be a little bit of an unwinding of that in the near term, so that the Canadian dollar will likely weaken. I mean, generally, we sort of talk about the dollar and Canadian dollars per U.S. dollar terms, and so that'd be weakening back to about the 140 range. However, we do think beginning in early 2026, the Canadian dollar will begin to strengthen as the Federal Reserve continues to cut interest rates and that spread between Canadian interest rates and U.S. interest rates really narrows. We think that's going to be a key driver of an appreciation in the Canadian dollar starting early next year. But we do see a little bit more weakness in the very near term.
Thank you very much indeed for joining us.